Hello everyone. This video is entitled How to Invest Part 1. In this video I'll start to drill down into the basics of building wealth. This is geared toward folks who have enough cash left over at the end of each month to start investing. And I want to talk about the sort of sequence I would go about doing it. Before I do that though, a quick disclaimer. The information shared on Joe's Finance Fundamentals is intended only to provide general financial education for informational purposes only. The information and opinions within should not be regarded as objective facts. This content does not provide financial, tax, legal, or any other professional advice. Personal financial decisions should not be implemented based on the content of this site. Do not act upon any information without first consulting a licensed investment, tax, or legal professional. Okay, with that out of the way, I believe the first thing you want to start doing when you're able to start investing is to build an emergency fund and to rebuild it if and when money needs to be taken out for anything unexpected. A house repair, a medical expense, a car repair, losing your job, that kind of thing. So that's going to be the first thing you want to focus on. And I'm going to talk about each of these things in more detail in this video. After you've got that under control, you want to start contributing to your retirement accounts. This would be more commonly known as a 401k via work and/or an IRA. Paying down debt, paying off credit card debt or any high interest debt that you have ASAP. After that, consider additional car or house payments or any other paying off debt, any other debt you may have. Saving for a house or another large purchase. Building your taxable investments. College savings plan. Building your taxable investment portfolio. And then when you've got all of those going concurrently, so this is not necessarily do one, go to number two, number three. The more of these you can do at the same time, the better. And when you have the first 6 going on and you feel good about that, there's other types of investments. One of my favorites is called the health savings account, which is actually triple tax-free when used for qualified medical expenses. I'll talk more about that. So in summary, as I said, the more of these you can do at the same time, the better. And by the way, I don't have any experience with other assets such as cryptocurrency, having rental income, buying gold or silver, having artwork or other collectibles. So I won't talk about those. So as far as how to get started and where this money resides exactly, these types of investments, like where do you put them? You basically have 3 types of accounts at the end of the day. You have taxable accounts. That's where your emergency fund, saving for a large purchase, building your investment portfolio. That's where that money goes. You have retirement accounts for your 401k and IRAs. And then there are a third type of accounts, kind of all other. The 2 biggest ones that I'm going to talk about are college savings or 529 plans and HSAs, health savings accounts. Most of these can be opened at the same financial or investment institution like a Vanguard or a Fidelity or a major bank. Now, for all 7 of these types of investing, wrapped around them and through all of them are my guiding principles from my first video of having a saver mentality, seeking diversification and balance, and learning from your mistakes. Okay, so when we talk about taxable accounts, I think of those as the foundational accounts you will want to use to start building your net worth. As I mentioned, the first priority is to build an emergency fund in a safe investment, such as a money market mutual fund. By the way, I view bank checking and savings accounts not really as investments per se, but funds you use for everyday life. These pay very little, if any, interest, and so any funds you have over and above your monthly needs, I'd recommend you put into a taxable account. As mentioned, to build an emergency fund, which experts say should have 6 to 12 months worth of living expenses, in today's higher interest environment, I would recommend a money market mutual fund, which are currently paying about 5% interest. You can easily write checks from this fund or transfer money to and from your bank checking account as needed. There are many different types of financial institutions, such as banks and investment companies, that offer these money market funds. After that, and after your debt is under control and you are funding your 401k and or IRA, there are a wide choice of investments, stocks, bonds, mutual funds, CDs, to start building wealth. You want to choose something consistent or based on your time horizon. For example, if you'll need the money within 5 years, choose a safer investment. If this is more of a long-term, 5+ year type time horizon, you could look to something that's a little bit more risky, but also will offer potentially more reward, like a stock, individual stock, or a stock mutual fund. And lastly, on taxable accounts, as the name implies, you will owe tax each year on any dividends and interest income. Lastly, on this taxable accounts, if you sell something for a gain during the year, you will owe capital gains taxes in addition to dividends and interest income, owing tax on that. You could have capital gains tax. The exact tax rate depends on your income. And also, if you sell for a loss, you do have the ability to deduct up to $3,000 of losses on your tax return. Okay, now let's move on to retirement accounts. And hopefully your company offers a 401k plan, and hopefully you're contributing enough to get the full company match, which is in effect money they are giving you for free. So the 401k is offered by many employers as a payroll deduction, as a pre-tax employee contribution before taxes, which lowers your taxable income. And employers may also match a certain percentage of that. It's important to read and research the investment options that your 401k plan is offering. Since your contributions are before taxes, taxes will be due once you start withdrawing money for retirement. You can do that without a penalty starting at age 59 and a half. Some companies offer a Roth 401k, which means all employee contributions are after tax. The employer contributions are still pre-tax. So you won't get the immediate tax benefits on your contribution because they are already have been taxed. But the good thing is you will never have to pay taxes on that money ever again, even after it grows into a much larger amount. Now I know it's easy, especially for younger folks, to not contribute to their 401k because they need the money for something else, or because retirement is a long way off. Believe me, that time goes quick. And everything you can do now to free up the money to contribute. And because retirement is a long way off, that's exactly why you should contribute now. Over time, your contributions and earnings will compound, and the results will be amazing. If you are not sure what compounding means, please view my video about net worth, which will give you some real examples. Lastly, on the 401ks, that you own that money, even the money that the employer has contributed as their company match, and you can take it from job to job. You can either leave it where it is if you leave that job, or you can roll it over into it's called a rollover IRA at your preferred institution. I've done that several times in my career as I've taken a different job. I would always roll it over. In my preferred institution happens to be Vanguard, so that it just accumulates into one account. I like to keep things simple. So again, as I mentioned with 401ks, the traditional 401k is tax deferred, whereas the Roth 401k, the earnings are tax free. You've already paid the taxes up front. Now, there's also IRAs, individual retirement accounts, which work very similar to the 401ks. There are two types. There is the traditional IRA, where you can get a tax break up front, or the Roth IRA, which works the same way as the Roth 401k. You pay the taxes up front on that income, but you're never taxed again. Generally speaking, for younger people, I believe that the Roth options are considered better options. For me, being an older person, when I first started out, Roth was not even an option. So I have both with 401ks and IRAs, both the Roth version and the traditional version. And each of these has maximum annual contributions. So you want to pay attention to that. Finally, on retirement savings in general, whether it be your taxable account, as I talked about a few minutes ago, or the 401k or IRA, in the last 20 years or so, there have been an explosion of what are called target date funds. So let's say you are planning to retire in 2040. You could invest all of your retirement money, if you wanted to, in just one fund. For example, the Target Retirement 2040 Fund, which will automatically shift to a more conservative, more bonds, less stocks as you near your retirement date. This is an easy way to set it and forget it. And this goes back to what I said earlier with your 401ks, to review the company, the options the company is offering in terms of where you can invest your money. With IRAs, because you set it up, you can invest that in whatever you'd like. Okay, let's move on to college savings or 529 plans, which, by the way, aren't just for college anymore. They can be used for any form of higher education. They're offered by many banks, brokerages, and investment companies. Contributions are after tax, but all earnings are tax-free, as long as used for eligible education expenses. And as I mentioned, they're not just for college, they can be used for private secondary education. 529s are open for a specific child, but can be transferred to other children. So if one child goes to college and you have money left over in the 529, you can transfer it to another child. And anyone can contribute. So grandparents can open accounts for their grandkids, for example. Lastly, the health savings account, or HSA, are a personal favorite of mine because they are triple tax free, meaning the contributions you make up to the annual limit are tax deductible, and sometimes they're covered by a payroll deduction at work, which is also pre-tax. So that income up front is not taxed. The money will grow tax-free in whatever investment, usually a mutual fund that you choose from the list of available options. And finally, any withdrawals are made tax-free as long as used for qualified medical expenses. So I highly recommend taking advantage of these if you're able to, and especially if offered by your employer. So basically, as you put money in, you can take it out at any time for medical expenses, contact lenses, or any medical expenses that are not covered by insurance. But you can also contribute more than you use and build this up over time. It becomes just like any other investment. As with IRAs, you own the HSA. And as I mentioned, you do not have to use the money you contribute each year. You can accumulate and invest these funds. And the triple tax-free, I'm not aware of any other investment type that is triple tax-free. So before I wrap up this video, How to Invest Part 1, and set the stage for what I will cover in How to Invest Part 2, I want to tell you a little story from when I was ready to start investing back in the late 1980s. Back then, all of the investment companies had their mutual funds and share prices listed in the Sunday paper, in the same section as the stock market listings. If you are too young to remember this, go ahead and ask a person, say 50 and over, and they can tell you more about it. Anyway, I was looking through the mutual funds when I came across a company by the name of Vanguard. And each of their mutual funds had the letters NL listed before the mutual fund name, which was different from just about every other listing from other companies whose funds had some what seemed like cryptic numbers shown before the mutual fund name. With a little digging, I came to find out that the NL stood for no load. Now, what does that mean? No load meant that if I gave Vanguard, say, $3,000 to invest, all $3,000 would be invested. Common sense, right? That's what I thought. However, on the other listings that had the number in front of the mutual fund name, I came to find out those were called a 12B-1 fee, which meant that if I gave another company the same $3,000 to invest in a mutual fund that I chose, they may only invest, say, $2,950. They took the rest up front as a marketing fee, whatever that meant. Well, no thanks to paying someone up front to invest on my behalf. So what drew me to Vanguard initially, and still does today, are their low costs and extensive list of investment offerings. They are not a publicly traded company trying to make a profit, but rather run their business at a cost and pass along the savings to customers in the form of low annual fees. Vanguard also has a very nice selection of mutual funds, which I'm a big proponent of, as you can probably tell, especially index funds. More on that in the next video. Vanguard's literature then and website now is not filled with financial jargon, but in terms everyone can understand about such things as risk and reward, cost, mutual fund objective, retirement planning, etc., etc. So for me, having my investment portfolio at Vanguard keeps things simple, which, as you can see at the top right of this page, is something that I value a lot. So thanks for watching. Keep an eye out for my next video, How to Invest Part 2, and have a great day.